Welcome to This Explainer. Today, we're diving into a massive, frankly wild fight night in the fintech world, breaking down a 24-hour period that seriously felt like a heavyweight championship title card. We're looking at an earnings season where the numbers are telling completely different stories depending on who is stepping into the ring. Today, we're going to look at 3 companies that just laid all their cards on the table, and the results are absolutely fascinating.
You get this immediate, really stark contrast between 2 Latin American fintech heavyweights who stepped up on the exact same afternoon. On one hand, you have a company literally popping champagne over some historic wins. On the other, you've got a company still doing the math, trying to figure out where things got just a bit too expensive. And as a total wildcard, we're also going to explore how Robinhood is suddenly letting everyday retail investors into a startup party that frankly used to require a Stanford email address to even get in the door.
So, here is the fight card for today's explainer. First up, Fight Night in Fintech. Second, Nubank's billion-dollar belt. Third, DLocal's growth versus discipline. Fourth, Robinhood hands out tickets. And finally, 3 lessons, 1 day.
All right, round 1, Nubank's billion-dollar belt. Let's look at how they are completely redefining the quarter.
$1.06 billion. I mean, wow, that is an absolute knockout punch. We're talking about Nubank's net income for just this quarter. It's the very first time they have ever crossed the billion-dollar mark at a single quarter, which is a massive 49% jump year over year. To put this into perspective, this is the fintech equivalent of a rookie stepping into the ring and just taking the heavyweight belt in their very first title shot. It is a monumental milestone for a digital bank.
And you know, it's fascinating to see how the underlying thesis of this company is just compounding right now. Let's break this down a bit. Revenue climbed 39% to $5.88 billion. The customer count across Brazil, Mexico, and Colombia hit an astounding 138.9 million. And look at that return on equity, an unbelievable 33%. That is a highly unbank-like number, to say the least. Remember, founded back in 2013 in Sao Paulo, the idea was super simple. A branchless bank could serve more people for less money. Well, 13 years later, founder David Velez isn't just proving that thesis, he's pouring gas on it. Mexico just became their largest digital bank with 16 million customers. And maybe most impressively, Brazil crossed 86% monthly activity for the very first time. That means they aren't just acquiring users, they are actively becoming their users' primary, everyday bank.
Now, the only slight wrinkle in this supermax level championship performance is this metric. 90-plus day delinquencies ticked up to 6.9%, up from 6.5%. Now, according to the data, this is largely due to seasonal migration from the first quarter. So while it's absolutely a metric that's worth keeping an eye on as they continue to scale, it's definitely not a reason to panic, especially given the overwhelming strength of their bottom line.
So, the crucial takeaway here for Nubank is that they didn't just win the round today. They completely rewrote the rulebook for what a digital bank quarter can actually achieve in Latin America. They are proving, beyond a shadow of a doubt, that incredible scale and incredible profitability can actually coexist in the neobank space.
Okay, moving to round 2, DLocal's growth versus discipline and the real cost of doing business.
So DLocal is essentially the global payments plumber for absolute giants like Amazon and Uber, basically making sure that a subscription paid in Sao Paulo can actually clear in US dollars. And looking at the top-line wins, that plumbing business is absolutely booming. Q2 revenue hit $399.7 million, and total payment volume reached $17.7 billion. Both of those numbers easily beat Wall Street's expectations. But you've got to look at the bottom line misses. They missed on earnings per share. Why? Because their operating expenses jumped an eye-watering 46% year over year. That cash went straight to higher headcount, salaries, and marketing. And as a direct result of that bottom line miss, shares slipped 2.3% in after-hours trading.
They also just disclosed a new $150 million credit agreement. So the big question investors are looking at right now is really a matter of scale versus efficiency. Can DLocal keep these massive payment pipes flowing without their cost structure creeping up like a Chipotle burrito line during a Tuesday lunch rush? It is a classic fintech dilemma.
And that brings us to a very clear takeaway. DLocal proved that demand for their product is not the problem at all. The growth is absolutely there. But, as we know, growth is easy to sell. Spending discipline is what actually gets you re-rated by the market. Their next big test is proving they can manage the immense cost of their own rapid expansion.
All right, round 3. Robinhood hands out tickets. Retail officially enters venture capital.
Stepping away from Latin America, let's look at a wild card in the US. This brings us to Robinhood Ventures Fund 2, trading under the ticker RVII. Today, they priced their IPO at $25 a share, offering 8 million shares and raising $225.5 million right there on the New York Stock Exchange. What this closed-end fund does is give retail investors exposure to roughly 80 early-stage Y Combinator-linked startups. And the real kicker here? Absolutely no accreditation required. Historically, to get in on these types of early-stage startups, you needed a Patagonia vest, a massive pile of capital, and an exclusive invite. Robinhood is doing what Robinhood does best, taking a gate-kept financial asset and just slapping a buy button right on the front of it.
Honestly, it's kind of like legally scalping tickets to an ultra-exclusive invite-only show. But if you're standing at the box office, you definitely want to read the fine print on that ticket. There is a 4.18% expense ratio built into the fund, which is a pretty hefty premium just for access. Furthermore, it is definitely worth remembering that Robinhood's first venture fund traded at wild premiums to its net asset value ever since its launch. So if you're watching this space, do not expect RVII to trade calmly at its $25 entry point for very long. The volatility is just part of the package.
I love this quote because it hits the nail right on the head regarding Robinhood's move today. They just turned the phrase, "I want in on the next unicorn," into a simple ticker symbol. They are once again tearing down the velvet ropes of private finance and handing a venture capital cap table directly over to everyday investors.
Finally, moving on to Section 4, 3 lessons, 1 day, the Fintech snapshot.
Let's quickly review the tape from this wild fight night. First, we saw a digital bank, Nubank, completely shatter expectations, proving that a branchless model can generate over $1 billion in quarterly net income. Second, we saw a global payments provider, DLocal, struggle with the sheer cost of its own massive scaling, proving that top-line growth is really only half a win if operating expenses are eating all your profits. And third, we saw a brokerage, Robinhood, successfully gamify and democratize early-stage venture capital, bringing retail money straight into the startup world.
So as you digest all these massive numbers and very different strategies, I'm left with this question, and I want you to think about it too. As we look ahead to the next era of fintech, which of these approaches is truly going to dominate the financial landscape? Will it be unbridled growth, strict operational discipline, or aggressive retail democratization that ultimately claims the championship belt? Keep an eye on those tickers, and I will catch you in our next explainer.